Hello guys, you're welcome to Coinspace with Austin. Today I'm going to be talking about the Fibonacci retracement level and how to use it in an uptrend market. And in my next video, I'm going to show you how to use it in a downtrend market. The Fibonacci ratio is a sequence of numbers, a sequence of levels that allows you to actually identify the trend of the market based on where it has retraced from so as to know if to go into the market in the case of an uptrend or if to exit the market in the case of a downtrend. Now I'm going to pull up my Fibonacci ratio, but before you plot your Fibonacci graph, you need to identify a swing low and a swing high. Uh, a swing low is where the market came down to before it started pumping up, which is about this position I'm going to pick right here. Because you can see it pumped up right from this position after this low. It pumped up to a swing high here. This is going to be my swing high because this is the highest point it got to before retracing back again. So I'm going to plot my Fib ratio from here now to this position, which is my swing high. Now, sorry about that. So right here now, we're going to see that it has levels. Now, this 0.6 levels is your golden ratio. Golden ratio. I'll tell you why it's called the golden ratio. And this is your 0.5 ratio, which is basically where you have majorly all the retracement levels where you can actually know when to enter a trade in the Fibonacci retracement levels. But let me just tell you how we got this whole number. Now this 0 position here to this 0.236 is 20% of this entire level. And from here down to 0.3 is 30% of this entire level. And also from here down to this 0.5 is 50% of this entire level. That's how we got these figures right here. Now let's look at the retracement level. Remember, this is your golden ratio, and this 0.5 is next after the golden ratio. Now you can see that there is an uptrend here, and at this position, more buyers at the position, the market retraced rather, the market retraced and buyers got in at this position. Now this is the retracement level, which normally falls between the 0.5 mark, and this is where the market retraced and you can go back into the market. Now this is how Fibonacci tells you where to go, when to go into the market with your retracement level. Now this golden ratio, when the market pulls down to this golden ratio, most likely the market is going to bounce back up, because sometimes the market does not retrace on this 0.5 line and it comes down to the golden ratio, which is basically where the market will push up from. Now this is how to identify a market trend, but like I always tell you, do not rely on just one particular indicator alone. Why? Because it is not reliable. It is not a wise decision. Even the whole technical analysis, it's not even 100% efficient. Basically, because the market is driven by the forces of demand and supply, and most importantly, the emotions of traders, which can actually go down or high. Somebody can wake up one morning and say, I'm selling off all my assets, and you don't really know what the person is going to do. So that is how the market moves. So you don't have to trade with just one particular indicator. No, combine two or more indicators so as to get a perfect result. If you're new, if you like this content, kindly smash the like and the subscribe button. It does help me a whole lot. Don't forget, I am Austin and this is Coinspace.